Hello, hello, hello. What's going on, everybody? Sorry about the little bit of a delayed start. I was having some technical difficulties with the webcam. I dropped my webcam and then it wasn't working after that. So I think I'm probably going to go have to buy a new one. I'll probably do that on the weekend or something. But anyways, can you guys hear me loud and clear in the YouTube land? The mic and everything is still perfectly fine. In the broadcast and everything else should be fine. Just no webcam today. You can't see my pretty face today, but you can listen to my voice today. I'll go buy a new webcam this weekend. Okay, so this is the normal Capital Hungry Market Update and Trade Ideas webinar as per routine, but the main focus point this week in terms of movement on US dollar pairs, gold, and the stock market is 1, the US CPI data tomorrow, and 2, the interest rate decision of the Feds on Wednesday. Okay. So because of that, you can see that in terms of market volume and volatility, we're having a relatively slower start to the week. Equities still aren't doing too much. We had that bounce off the 33,500 key level. Gold having a bit of a pullback from those 1810 highs. GBPJPY extending a little bit higher, respecting some bullish structure. Dollar weakness extending further, but overall just ranging, as the markets are waiting for some of the key events in the second half of the week. Now, yes, the US CPI and Fed interest rate decision is very important in terms of dollar sentiment, gold, and equities, but we also have other central bank rate decisions this week, such as the ECB and Bank of England, which is going to be important in terms of impact to Euro and GBP. This webinar, we're going to be doing some prep and understanding of what to expect for the CPI, maybe even giving some tips and secrets for the FOMC to come. And then the second half of the webinar will be trade ideas for the Asian session, London and pre-New York. The first half of this webinar is going to be educational review and prep for understanding the CPI and various scenarios and impact, as well as trade ideas to follow. Okay? So, a little bit of an educational review and just a quick reminder here. What we have been seeing over the course of the last year and a half, and the reason gold dropped from the $2,000 an ounce price point all the way into almost the 1600s flat, was the market pricing in the aggressive rate hike cycle by the Feds, right? So this was the main driving factor and fundamental catalyst leading to this downside on gold. That's what led to the stock market being more bearish, and that's what led to dollar domination, a sentiment that we were playing for an extended period of time. So money markets pricing in Fed rate hikes. And we had continued data catalysts that supported these Fed rate hikes, such as strong labor market data, high CPI reports, hawkish FOMCs, right? So every single time we'd have this information advantage in play, that being the main fundamental catalyst driving the order flow from an institutional algorithmic perspective, you would have these extended legs down on gold, have a pullback phase for a short period of time, all the way until you retest a better sell zone of interest after the pullback phase is completed, still continuing the overall higher time frame trend, right? That's because up until pretty much November here, we had these fundamental catalysts in play and holding the most weight. But as over a year in terms of the timeline has passed, The market has been pricing in the consistent rate hikes, the consistent higher CPI reports, stronger labor market data, and hawkish FOMCs. The order flow has been adjusted accordingly. We saw dollar go extremely bullish during that period of time. We saw the stock market correct to pre-pandemic highs. We saw gold go from $2,000 an ounce to $1,600. We've seen the real estate market in North America cool and so forth as well. But what we're having take place now, ever since the labor market report, reports in November onward, and then the CPI reports that followed in Jerome Powell's speech, are fundamental catalysts that are feeding into Fed pivot prayer hopes and going against this narrative, right? So here we had a bad unemployment report, priced in FOMC sentiments, improved CPI, neutral to dovish Jerome Powell speech as well, which all of these catalysts and fundamental events are the opposite of these and have the opposite market impact. This has been the main reason why pretty much since November onward, dollar has been bearish, stock market has been bullish, and gold has been more bullish, right? So we also have to understand that this lines up with market timing as we're approaching the end of the fiscal year, as we're approaching obviously the holiday periods in Europe and North America. We can see from a political and corporate perspective, optimism being maintained very high to keep consumer morale, consumer activity, and investment activity up to prevent any panic selling, mass recession fear, or any fear into the end of the year here, and keeping everything smooth sailing up until the new year, right? We can see this sentiment here of dollar weakness, gold upside, stock market upside easily extend into January, and then come late January and February, inflation reports are still going to be very high, and then the Feds will end up bringing the heat again, end up being very aggressive with rate hikes, and this will come back into play. But right now, we haven't had any confirmations of this coming back into play. We've had the money markets already adjusted to the rate hikes. We've had some of the labor market data weakening with a bad unemployment report. We've had some of the inflation reports improving, not continuing to increase. And we've had the hawkish FOMCs priced in and faded out, and had more neutral to dovish speeches that followed so far, right? So if we don't get extremely high CPI reports, if we don't get very optimistic labor market data, if we don't get a very hawkish FOMC and Fed interest rate decision, right? Then if we don't get a very hawkish FOMC and Fed interest rate decision, then we're still going to be continuing the dollar weakness sentiment and bias, gold buys, stock market buys, at least into the end of the year and into the new year, where then into the new year, we have a higher probability of seeing the February inflation reports being a lot higher. Jerome Powell's speech was neutral to dovish because it didn't bring any new events to the table. The 50 basis point rate hike is already expected, well known and priced in, and you can see that they didn't talk about anything in terms of a hawkish sentiment. They actually talked about rate hike slowdown being within the scope and window, keeping optimism higher. So when we're looking at gold now on the intraday time frames, you can see, yes, we're getting some minor signs of exhaustion with this double top at the 1800s, but we would need to be trading well below the 1760s to see any shift out of intraday bullish market structure, as it's very common for gold to do pullbacks to generate some more buy side volume and liquidity before continuing overall bullish. The main fundamental catalyst, I'm expecting overall dollar pairs, gold, GU, EURUSD, and the stock markets to range up until CPI tomorrow morning. Now, CPI here is going to be whether we feed back into rate hike cycle or we go into Fed pivot prayers further. Remember, so over the course of the last year and a half, we've seen this hold the most weight. Hence why we've had dollar domination, gold go from $2,000 an ounce to $1,600 an ounce, stock market go from all-time highs back to pre-pandemic highs, real estate market more bearish, less investment activity, and so forth, right? But as all of this information has been priced in, the market adjusted to it, and on top of having market timing of coming towards the end of the fiscal year and holidays, we've had catalysts over at least the last month and a half that have been feeding into this narrative. We've had worsening US economic data. We've had labor market with unemployment rate worsening. We've had improved CPI reports, which this leads to this impact of USD bears, gold buys, and stock market buys. Hence, you can see ever since even the last CPI report, which was here, and then, ever since the last CPI report, which was here, and then Jerome Powell's speech, which was here, those were some of the catalysts that led to impulsive dollar weakness from the improved CPI report feeding into Fed pivot prayers, and then a neutral to dovish speech in those previous weeks there feeding into those Fed pivot prayers, and more demand in the stock market, more demand in your risk assets and risk currencies, right? So understanding this, the reason why I'm talking about this is that this gives you very easy to understand information of what you can expect with this CPI report. Let's look at the CPI report tomorrow. We'll put it right here. Now, the main focus for the CPI report, the main catalyst that's going to be bringing some volume and volatility, and the main driving factor for dollar pairs, gold, stock market, and the main focus point prior to FOMC is this CPI. No Faluli, you're a retard. You can't even spell control correctly or countries. Just pay attention. What I'm telling you is the reason for dollar weakness recently over the last month. Just listen. It's the fact that we're coming towards the end of the fiscal year, having that correction from all-time high, from new highs on the dollar. We're having catalysts that lead to dollar weakness. Bad U.S. economic data, improved inflation, dovish Fed speech and rumors of Fed pivot. These are the reasons that led to dollar weakness. You can see that directly by looking at the last CPI report impact on the dollar, the last PPI report impact on the dollar, the last increased unemployment rate impact on the dollar, and then Jerome Powell's speech impact on the dollar. And we also gave those trade ideas and analysis ahead of time. Pay attention. Your IQ and brain is too retarded to make up some reasons of why the market is moving the way it is. This is real world economics and fundamentals. 1 + 1 = 2. You're trying to do 2 + 2 + 5 - 3 × 100 equals dollars bearish, and it's not right. Some retard shit. All right. So tomorrow, the main focus here is really the CPI year-over-year change here, where we're going from the prior figures of 7.7% with expectations of 7.3. Now listen very carefully, right? I personally think this is my expectation. I personally think that the CPI yearly can come out at like a 7.5, and then that the CPI monthly can still come out at like a 0.3%. I think that yes, the CPI is still going to be showing signs of improvement, but be above this forecast, because that forecast of 7.3 is very optimistic in asking for a lot. Coming out at 7.3 or lower would show major signs of improvement on inflation. Holy crap. Would show major signs of improvement on inflation, leading to this impact here. But I personally think we're going to be better than prior, still showing signs of improvement, with CPI decreasing being a good thing, but above the forecast. In my opinion, that will lead to still the impact of US dollar bears, gold buys, and stock market buys, but not major volume and volatility. Let's just say that this orange arrow I'm moving right now is if we come out at above forecast but below prior. I'm expecting gold movement to show a liquidity grab down before spiking bullish. So this is going to be a little diagram. Gold CPI move. Gold CPI move here if data above forecast but below prior. Liquidity grab before buys, right? Now, if this data, let me do this a bit better here. So before market opens, yo, you guys are next level retards in the chat. Some of you should not be trading. Some of you should not be trading. Trading's not for everybody, by the way. You know what I mean? It's a very dangerous game, very high risk. It involves a lot of effort, studying, high IQ, constant training of your mind, your emotions, developing of knowledge and experience. And some of you can't even figure out like what time a report's coming out. You know what I mean? Like very like like you're 90% of traders already lose, and so like think about your probability. It's not looking so bright for you. Just try something else. You know what I mean? Maybe try your luck at something else. I'm being dead serious. Don't waste your money. You're gonna get addicted to the markets. You're gonna get addicted to gambling. You're gonna end up losing day in and day out. Like, save your money, save the stress, save your hairline, and just try something else. Try something else. Save this for the people that got the time and effort to sacrifice into studying economics, finance, risk management, psychology, and so forth. You know, it takes a lot. I'm being completely dead honest and brutally honest with you. But anyways, guys, let's go back to focus point here. I just wanted to, so I can draw a better diagram. I can space this out a little bit better here. Okay, so this is an example, and I'm gonna show you guys on the charts of what prices I would expect to retest. But this is my main bias expectation. Okay, so Jeeves' main bias, we'll put it down here. Good luck. How about you shut the fuck up, lick my balls, and get off the stream? I'll go at the pace I want to. It's my stream. It's my knowledge. It's my brain. You're the one here waiting for information and trades to follow because your IQ is low and you're trying to gain IQ points from me. So how about you shut the fuck up, be patient, and be happy I'm giving away my IQ. I'm giving away my intelligence for free out here. Telling you guys about real world economic data, the expectations, the impact it will have, and how to trade it. All right? Yeah? We good? All right. So listen up now. Main focus CPI tomorrow. Jeeves' main expectation. So this could be like on the yearly CPI. On the yearly CPI, 7.4 to 7.5%, and then the monthly being pretty much the same. What I would expect on gold movement is a liquidity grab down first before then continuing bullish. Even though the data is going to be potentially my expectation, even though the data can be higher than the forecast, if it's still better than prior, right? If it's still showing signs of improvement and decreasing, it's still falling under this category overall here. It's still falling under this category all overall here, and still gonna have this impact over here. Okay? It's just in terms of the impact, it's gonna be less volume, not as much of market movement, and you're gonna have a higher probability of a liquidity grab. So let me note that in here. Higher chance liquidity grab. Less volume, you guys can see here. Liquidity grab, higher probability liquidity grab, right? Now, if inflation is just extremely optimistic, This will be higher volume move, a larger impact move, gold straight bulls, dollar bears. In the example of gold movement, you would really have gold just pushing straight bullish. Maybe a very minor liquidity grab or very minor pullbacks on the lower time frame, but just pushing straight bullish. Larger impact, lower time frame, higher volume. This would be in the example if the data comes out here and CPI is at like 7.1% on the yearly, below the prior, below the forecast, 0.2% on the monthly. This would be heavily feeding into Fed pivot prayers that the Feds can slow down their rate hikes, that they do not need to be as aggressive, and that would lead to instant, more aggressive gold upside bullish push and dollar bears. JR Bliss, you're a retard as well. You don't understand market timing, paying attention, nothing like that. It's all good. You guys can rewatch this and take some better notes. You know what I mean? Now, if inflation is very high still, we would need inflation here to come out to 7.8 to 8%, monthly to come out at like 0.5% and be showing signs of increases. If inflation is showing aggressive signs of increases above the prior and above the forecast, both on the monthly and yearly, that would lead to higher volume gold downside and dollar bulls. Okay? These are the three scenarios that can play out. So let's talk about this in further detail and example, looking at gold and talking about a scenario from current price point, right? And remember, this is my main bias. My main expectation, my main bias. I personally predict, with how we've seen the last inflation report, how producer price index still showed signs of improvement, how we've seen the Feds do aggressive front loading of rate hikes, understanding market timing of how we're approaching the end of the fiscal year and holidays, and they want to keep consumer morale higher and investment activity higher into the end of the fiscal year, and how Jerome Powell had a relatively neutral speech talking about how they can potentially slow down rate hikes. I think that the CPI is going to be lower than prior, but higher than the forecast, potentially coming out at 7.4 to 7.5% on the yearly being the main focus. I think that can lead to an aggressive liquidity grab down on gold first, before then turning bullish after stabilizing and retesting a key liquidity zone, which would also correlate to dollar doing an upside liquidity grab before turning bearish. But if I'm wrong and we have an even more optimistic report, you're just going to have this impact. Or if we have very high CPI, you're going to adapt to this impact. But we're going to talk about that in even more detail right now. So from a technical perspective, when we're looking at the dollar here on the intraday time frames, we can easily still come to retest higher time frame bullish market structure that's been created, as we're still respecting this bearish pullback structure from the highs, as long as we're holding below 106. If we still get that mixed to improved CPI report, whether we do a liquidity grab up or not, or just have the improved CPI report, we can easily still have dollar come to retest 103s, 102s, play here until the end of the year, then see dollar domination be coming into the new year. late January, February 2023, when inflation's still going to be very high into the new year. All of that holiday spending and surge has been digested into the markets and economy, leading to still higher asset class prices and higher inflation. And then the Feds will have to come in and bring the heat, leading to more rate hikes, aggressive hawkish tone, which gives dollar great ranges to play back to the buys, stock market turning bearish, gold turning bearish again as well. But I still think dollar can have some downside into the 102s, 103s, and then we'll see dollar domination in bulls, stock market bears, and gold bears potentially into 2023. Does that make sense to everybody? So even from a technical perspective, as long as USD is still printing these intraday lower lows, holding below 106, and if we have the improved inflation report and a neutral FOMC, we can easily still come to 102s, close off the month and year in this area around 102, 103, then come into the new year when we still have very poor economies, still have high inflation, dollar domination, and the aggressive rate hikes by the Feds come back into the scene. But anyways, from an intraday technical perspective, as long as USD is still holding below 107 handle here, and on the intradays below 106, we're still technically bearish. And if we're trading below 104, we can still see some more downside to the 103s and 102s. Right? Gold here on the intraday time frames, as long as we're still holding above that liquidity zone, roughly above, even here on the 1770s and more above the 1760s, we're still very bullish here on the intraday time frames, understanding price action and structure. So now let's talk about a potential scenarios with the CPI report if we were sitting at the current price points we're at right now, right? So let's just say we're sitting at these current price points right now, and the CPI report's about to come out in 2 more minutes, right? Remember, scenario 1, high CPI, kills Fed pivot prayers, prices in higher rate hikes to come. Right? right? So let's do an imaginary scenario right now that CPI is about to come out, right? If we have these various scenarios from the current price points of interest, this is what I would personally see. So in the example here of looking at gold at current price points of interest, we can see clear key areas of interest around 1805, that zone we broke out of around 1765, even this area of interest around 1780. CPI report is coming out in 3 more minutes. Scenario 2, this one, my main expectation, let's just say we were sitting at the current price point, you'd more than likely see a deeper liquidity grab to like this price sensitivity area and here where we had the Jerome Powell speech before turning more bullish and just continuing back into the range and into these range highs. Scenario 3, just having optimistic CPI, you would just be pushing bullish and also have a higher probability of extending above the 1805s, 1810s with more impulsive one-sided volume continuing higher in that fashion. Scenario 1 here, you would be breaking below and also having the sells below 1765s, right? So in the example of trade ideas, if you were to have, let's just say we were sitting at these current price points of interest and the CPI report comes out. If we were to have scenario 1 of very high CPI, I would be looking for the gold sells below 1765 and then also canceling out the Jerome Powell move in below 1740. If we had scenario 2 play out, I would be looking for high risk, high reward buys and support created after liquidity grab at 1765, flipping back bullish above the 1780s. If we have scenario 3 of very optimistic, I would be looking for the safe and steady buys above 1805. An example of scenario 1 movement in the actual figure would be CPI yearly coming out at like 8% still and CPI monthly at 0.5. That would lead to this type of movement if we were talking about CPI report and the gold movement from current price point. Probably 100, 200 pips, continuation to the next daily candle as well. US dollar strength, gold bears, right? What I personally think is something like this, where the CPI here can come out at like 7.5, CPI monthly still at like 0.4. Monthly not seeing much change, yearly inflation still showing signs of improvement, but not close to the optimistic buffered forecast, leading to a downside liquidity grab first, then flipping bullish. Scenario 3 would be extremely optimistic inflation coming out at like 0.2% on the monthly, below forecast and below prior, 7.0% on the yearly. That would just lead to straight impulsive gold upside, stock market upside, dollar bears. If CPI comes out at 7.3, that's still scenario 2 and 3 here. That's still very optimistic. That's improved. If CPI here comes out at 7.3, that's still falling into a mix of these scenarios. Seeing a bit of a liquidity grab on gold and then continuing bullish with dollar weakness. All right. Now, this same type of idea in scenarios will also be the impact on GBPUSD, EURUSD, and the stock market. Because the main information driving factor for dollar pairs, stock market, and gold that the markets are waiting for is the inflation data. So as we have the US CPI, tomorrow morning during the New York session at 8:30 a.m. Eastern, there is higher probability we can see gold, dollars, pairs, and stock market like US 30 ranging until the CPI report. Okay? 7.6% would still be scenario 2. Good question. Walls Vog. 7.6% yearly being below the prior but closer to the prior and above forecast would still be scenario 2, but a deeper liquidity grab I'd expect and a more aggressive sporadic lower time frame price action. Right? Now, remember, this is potentially the impacting factors with the CPI report and what it can lead to on gold, dollar, and dollar pairs. The following important fundamental catalyst is the next day, which is the Fed interest rate decision. I personally think that if we see this CPI report is falling into scenario 2 or 3 here, showing signs of improvement, that this FOMC is going to be a write-off. What do I mean by that? Well, Jeev, what do you mean by this FOMC is going to be a write-off? I think that this FOMC is just going to be a copy and paste of the Jerome Powell speech from the previous week. It's just going to be a write-off, a dead dud FOMC where they just do the 50 basis point expected rate hike. They don't bring any major volatility or impact to the market. They let the market sail smooth and steady into the holidays and end of the year. And then into the New Year's, like February and onward, they'll bring the heat with very hawkish interest rate decisions again. Does that make sense to everybody? So if we see a relatively neutral to improved CPI, I can also see that signaling to a very dead to neutral FOMC, where the Feds will just say the same shit they've already said. They'll do the expected 50 basis point rate hike. They won't bring anything new to the table. They won't try to shock the markets before Christmas and the holidays and the end of the fiscal year. And they'll keep everything sailing smooth and steady as it sets up order flow into the new year. Then come the new year, when they want to be very aggressive with rate hikes again and bring the heat, the stock market is at great highs to offload positions for the whales and for the bears to come back into play. And dollar will be at great buyer areas. Dollar will be at great buy areas around the 103s and 104s as well, and have great ranges to play to the upside again. I know what I'm saying can be very confusing if you don't understand the concepts, but a lot of these concepts are taught in the free. This YouTube channel has 350 plus webinars. Educational webinars on central banking, monetary policy, US dollar domination, historical analysis, higher time frame analysis, intraday, price action, live scalping, and everything in between. The Capital Hungry private channel has even more information. 100 just educational webinars from basics to advanced topics, right? So you have to spend the time and effort to learn as much as you can, and you do have all these resources at your fingertips. But hopefully, for the people that are in here right now, you're finding this information useful, valuable, and educational, especially as it's for free. You know what I mean? Of course, I do this to advertise the Capital Hungry service and grow my brand, but I also do this to help the community share value and share my knowledge, because teaching keeps me sharp as well. Constantly repeating concepts, going through this analysis, being able to break it down and explain it to others, being able to share these various concepts, educational concepts on fundamentals, economics, psychology, and so forth. It also keeps me very sharp. This is my work ethic as well. My practice day in and day out, right? So hopefully you guys enjoyed this content. But anyways, so the first half of the webinar, just a little bit of educational review, understanding some of the fundamentals, some CPI prep work, my main expectation, but the main 3 scenarios to look out for, the impacts to expect as well, and just some hypothetical scenarios of the movement I would expect if we were about to have the CPI report released and we were sitting at this current price point around 1780, right? Adapt this analysis to where gold is going to be sitting in the morning around 8:30 a.m. Eastern. I personally don't trade anything before the news. Like, I don't take an entry right before the data release. I don't do any buy stops or sell stop guessing. I wait for the data, I wait for the impact, and I grab my piece of the pie. Whether that's waiting for the liquidity grab, whether that's waiting for the break of a key price sensitivity area on lower time frame confirms with the data confirms, I wait for those confirmations. Because remember, as a manual retail trader, we have access to retail quality resources, brokers, and so forth. What I mean by that is, even if your prediction is right, even if you're not using fundamentals at all, and you're just doing a news prediction based on technicals, even if your prediction is right about the direction you expect, you can still lose the trade based on volatility, order slippage, spread spikes, brokers freezing, and so forth, right? So I'm somebody who's been trading for 6 years. There's been plenty of times that I've tried to trade before news and known exactly what the fundamentals will be, exactly the impact. My prediction is right, and I'll take a trade before the data, but I'll get caught in a spread spike. You'll get caught in your order getting slipped. You'll get caught in a heavy liquidity grab that can occur before, right? You can have liquidity grabs even if the data is expected as you want. You can have liquidity grabs that happen in a singular minute before still continuing the move. So you could be right with your prediction and still lose money just based on the volatility of news that comes into play. So always be smart, wait for the data to get released, understand the impact, wait for your lower time frame confirms, grab your piece of the pie, and get out with confidence and less stress and less emotional tension. All right? But anyways, now, the rest of this webinar, the next 15-20 minutes, is going to be analysis and trade ideas for Asian session, London, and pre-New York. Yeah, taking trades like the London session before and things like that, that's perfectly fine. You could easily still have healthy volumes through this next Asian session, London, as the data report and focus is still 12 plus hours away. I just mean, don't be taking any trades trying to gamble right before the data release, right? But if you're in a trade, let's just say in a gold trade at London, and by the data, you're well in profit, 50 pips, 100 pips in profit for a day trade, and you want to risk holding it into the news trade risk-free, that's perfectly understandable. But if you're just entering right at that price point right before data, or entering some buy stop and sell stop, even if your prediction is right, there's still a high probability you're going to lose, again, with spread spikes, order slippage, brokers freezing, liquidity grabs, and so forth. That's gonna take out a retail trader stop loss. You know what I mean? But anyways, everybody, in terms of the economic events that we have overnight, we also have some CPI figures for Germany overnight at 2 a.m. Eastern. That won't have too much impact at all. It's already well known and priced in on the Eurozone inflation side of things. ECB still has to do more aggressive rate hikes. We're expecting the 50 basis point rate hike from ECB later this week. Every central bank should be doing a 50 basis point rate hike, priced in expected rate hike this week. Also at 2 a.m. Eastern, we have labor market data for the UK. We're expecting to see an increase in unemployment rate, which can keep GBP a little bit weaker if it comes out that way. If the unemployment rate is still sitting at 3.6%, that can still keep us on our GJ bullish bias and playing some of that to our advantage, okay? Other than that, nothing really too important until the CPI data for the US at 8:30 a.m. Eastern, which we just did our prep work for that. Then on Wednesday, we have the US Fed interest rate decision. The day after that, we have Bank of England and ECB and all of our PMI figures and other US retail sales after that. Very, very high volume, high volatility week that should bring you a lot of opportunity if you're smart. Nothing going on in terms of central bank speakers as we have the rate decisions later in the week. So not too much else going on there. FOMC is going to be on the Wednesday. Okay. Now, I gave you guys the scenarios, an example for CPI on gold that can also be applied in a very similar fashion to GBPUSD, EURUSD, and the US stock market. These trade ideas I'm about to give you across pairs right now are for the Asian session, London overnight, and pre-New York. But then, during the North American session, it's going to depend on CPI and the data and what scenario we fall under, right? So these trade ideas I'm going to give you are for the next coming sessions. But then tomorrow morning, it's for dollar pairs, gold, and stock market. Everything depends on the CPI data up until the FOMC the following day. Understand, everybody? So now on gold. On gold here, on the intraday time frames, I'm still in a bullish bias. Just because we're getting a little bit of exhaustion at the same intraday high doesn't mean that I'm going to start getting faded out of the buyer analysis just yet. As long as we're holding above this key zone and price sensitivity area, roughly above the 1760s, we may see some short-term sells down to this area, but I'm still bullish above the 1760s, and especially if we come back above the 1790s. In terms of market sentiment, we still have US dollar weakness, more demand in our risk assets such as the global equity markets, and still have gold bullish structure holding the most weight. I would personally be looking to see that even if we get pullbacks to 1772, holds back above 1781, breaks above 1789, I would still be looking for gold buy scalps from these levels in gold day trades. I can only sell with technical breaks below 1765 and more than likely a very high CPI report leading to technical breaks below 1764 and dollar strength. On GBPUSD, we're still respecting bullish structure. We still have dollar weakness. We still have more demand in our basket of risk currencies and risk assets ever since the neutral to dovish Jerome Powell speech. Even if we get pullbacks to 1.2165, retests of 224, and breaks above 2-3 higher time frame key levels, I would still be looking for GU scalps from these levels and GU day trades. UK equities are still holding bullish. We still have dollar weakness in terms of sentiment confirms, bullish price action and bullish structure, no real reason to sell. We've just been consolidating here to start out this new week. I would only be selling below 1.21. Again, UK equities starting to still stabilize, retesting previous price points after highs. US equities still bullish. German equities still bullish here as well. Dollar individually bearish in terms of sentiment confirms. So we still want to play that same sentiment continuation from the Jerome Powell speech, just understanding we have less volume and volatility as the market makers are waiting for, as the smart money and market participants are primarily waiting for the CPI data tomorrow, US FOMC and interest rate decisions to come. EURUSD, similar idea to GBPUSD. We still have more demand in our basket of risk currencies. Euro stock still holding bullish, showing optimism within the Eurozone in the short term. We have potential of a more hawkish ECB this week to bring Euro strength. Dollar weakness still active. Bullish price action and market structure just ranging at these intraday highs. Deeper pullback to 1.046. Holds of 1.052. Breaks above 1.056 would be buy still. Now remember, These trade ideas on gold, GU, Euro USD, US 30 and stock market, right? US 30 and USD CAD right now. This is for overnight and if inflation is still improved. What's also going to be the main driving factor is FOMC on Wednesday. You're going to need a neutral to dovish FOMC, just the priced in expected 50 basis point rate hike, no new hawkish remarks. Talking about rate hike slowdown, you will need those types of confirms on Wednesday as well to continue the dollar weakness sentiment, gold buys, and stock market buys. These are just trade ideas, obviously, for the sessions up until then, and depending on CPI tomorrow with the scenarios given out. But US 30, stock market is still bullish as we see that optimism and Christmas holiday rally ensue. Previous Fed interest rate decisions have been priced in. We've had improved CPI and PPI reports, more demand in your risk assets, dollar weaker, double bottom further retest of 33.5, breaks above 34K, breaks above 34,300 would still be stock market buys. USD CAD, more of the inverse. I'm looking for UCAD sells from a retest of 1.365, breaks below 1.36, and breaks below 1.355. And last but not least is GJ. I've still been in a GJ bullish bias as long as we're holding above daily demand zone at 165 here. As we're still respecting higher time frame bullish structure, we still have the rate differential of a hawkish Bank of England and a dovish Bank of Japan. We've had more demand in our risk assets, including your basket of risk currencies, which GBP is a part of. We're starting to trade above 168. Yen strength hasn't had too much impact on keeping GJ bearish. It's just led to some more aggressive ranging and pullbacks on the intraday time frames. I'm still bullish on GJ, holding above 168s to still trend into the 170s, especially as I'm expecting a hawkish Bank of England this week to still bring some more demand into GBP, and we still have more demand in our risk currencies overall here anyways. When I'm looking at GJ, we're having the stronger intraday bullish structure forming. If we do get breaks below 168.5, I'd be looking for buys from 168, breaks above 168.8, and breaks above 169 buys on GJ. Yen is still bearish on the higher time frames. We still have demand and optimism in UK equities. Risk assets holding more demand. GJ bullish intraday and higher time frame structure. Just have these minor pullback phases and continuations. All right. But anyways, everybody, almost an hour-long webinar. I've been ranting and rambling, giving a lot of fundamental information, technicals, talking about economic events, market timing, and so forth. I gave you guys prep and expectations for CPI, talked about FOMC and those events to come, all of the fundamentals later in the week, trade ideas and analysis for the coming sessions. This is going to be saved and uploaded, and you can always rewatch it as you wish. If I get time this Thursday, as I've just been busy with a lot of expansion and capital hungry, social media stuff, things in my personal life as well. If I get time, I'm going to be doing a scalping session on Thursday after the FOMC sentiment's in play. We can get some nice volume and volatility and some pretty easy trade ideas. Potentially Thursday, 7 to 7:30 a.m. Eastern. Make sure if you guys enjoyed this content, like, subscribe, and share it around. I don't know many other services, marketers, influencers, gurus, or people in our retail trading space that provide as much value as Capital Hungry, and especially for free. 300 plus webinars on this YouTube, dozens of reports, dozens of reels and short videos and content on the IG, charts, trades, and information on the Telegram, news headlines, breaking news and events on the Twitter. So If you guys enjoy the content, do your part, and it's free to do. Just like, subscribe, comment on all of CH content. It takes a second. It's free to do. It's easy. Share it around in other trading communities. Share it around in other groups with other people, and help us grow further into 2023. After this week, I'm going to be on vacation and holidays from until the new year. So just a reminder, from December 18th to probably like January 2nd, there's not going to be any YouTube content or any social media trading content, right? But then 2023, we're coming hard. We're coming with we're putting our foot on the gas, and we're bringing the heat. There's going to be a lot more content, market updates, educational webinars, live scalping sessions, reports, short form content, educational content, and more. All right. But after December 18th to like January, I'll be taking a break for the holidays. But then 2023, we're coming back full force. All right. All right, everybody. I'll probably see you guys. I'll see you guys on Instagram. I'll do an IG live this week doing questions and answers. I'll do a question and answer on IG live this week as well, just answering any trading questions, market questions, psychology, and so forth. Potentially see you guys later on YouTube this week, and I'll be making some more appearances on Wix Don't Lie, Raja Bank streams as well. Up until next week and into 2023, I'll be making a lot more appearances on his streams, sharing information and value as well.